but not so tepid when it comes to some individual stocks that are out with earnings. Netflix, for example, those shares have been tumbling today after the company gave out a forecast for subscriber growth that was lower than anticipated. We're going to talk more about that in just a moment. We got some interesting economic data today. Housing starts up 17.3% last month. That was just shy of estimates. Building permits also just shy of estimates with an increase of 2.1%. And consumer sentiment coming in below estimates in a little bit more of dramatic fashion. The University of Michigan's confidence reading unexpectedly falling in July. It's a preliminary reading for July to 73.2. Also, we have to talk about what continues to go on with the coronavirus. 77,000 cases reported yesterday. That is a single day record. We have been seeing a lot of single day records, so we continue to watch those numbers as well. Let's jump right into it though and talk about what's going on with Netflix here today. Right now, the shares are down by about 7%. Let's bring in James Cakmak to talk about that. He is Clockwise Capital Partner. He's joining us from Miami. James, it's good to see you. So it always fascinates me with a name like Netflix. The shares are down 7%. The forecast was disappointing. By and large, if you talk to analysts, they're still pretty positive on this company and its long-term prospects. How are you viewing these results?
Yeah, I mean, we think that Netflix is the gold standard is in the market right now in terms of content creation. You know, the analogy that we like to make is it's a lot very akin to like a Zara in fast fashion, because they're so proactive in being quickly reactive to changing market conditions and types of content. In fact, they even called out TikTok as a competitor to show, you know, how they're thinking about the world as content creation accelerates and the sources of distribution grow in tandem. So they're very, very forward-looking. I think investors, were kind of putting the cart before the horse here with demand pulled forward during COVID, so the back half is disappointing somewhat, but at the end of the day, I don't think the overall strategy or outlook on the stock has changed, though we don't personally own it in the fund given the stretched valuation.
Yeah, James, I kind of want to talk about that idea of the subscribers being pulled forward because of COVID and because so many people need something to keep them occupied. Wall Street's reaction to that seems, in my mind, to be a little overblown. I mean, they beat still on subscribers and revenue. This is basically just an indication of what we already knew. So why do you think we're seeing this kind of reaction to the stock?
Yeah, I think it was just the expectations that this COVID bump would continue to increase, you know, with the lockdowns and everything that's happening. But I really do think that you have to look at this company more on an annual basis, because you will have ebbs and flows in terms of subscriber growth depending on the hits that they're releasing and whatnot. But at the end of the day, you know, when you look at the business operating economic performance of the company, you know, we've got a snapshot of what the cash flow characteristics could look like. You know, you had the content costs to amortization ratio of 1, which is the target, and that yields a 15% cash flow margin. And we think that, you know, that extrapolating that gives a sense of hope as you look down the road that this is not going to be a cash burning company, but ultimately on an annuity-driven business through the subscriptions with their improving retention rates. You know, there is a very viable business model, but you can't look at it quarter to quarter.
Hey, James, Rick Newman here. With the proliferation of all these services, it becomes an important question. How many of these is the typical consumer actually willing to pay for? What is your sense of that at this point? And is that being affected by what's happening in the economy? I mean, some people just having less income, less household income, or maybe it's the flip side of that, which is they're more willing to cut the cord and do away with cable and spend a little bit more on streaming.
Yeah, that's a great question. I mean, ultimately, you know, on an a la carte basis, you know, you are looking at probably a premium to what you're paying on a bundle. So we do think that there is a natural ceiling in terms of, you know, the number of services that a customer is likely to subscribe to. And that's one of the reasons, you know, we're slightly hesitant on Netflix. You know, if we were earlier on in the ARPU, which is the price per or the revenue per user, we'd be more bullish on the name. But they've constantly pushed up pricing higher every single year like clockwork. And we do think that we're reaching kind of a ceiling point here, which is going to, you know, impact some of the growth levers of the company. So I think the the fact that it is increasingly fragmented and more competition is out there is going to make customers, face some trade-offs for sure.
Hey, James, when you look at the international market, obviously they're not pulling in as much revenue as you would from the Western markets, the U.S., Canada specifically. I guess, when do you think Netflix will pull the trigger and start to raise prices on those markets? They really do have a large opportunity there, but obviously don't want to scare away customers.
Yeah, I think international is huge and probably underappreciated. What the internet provides today is basically the ability to have fixed infrastructure in one place and be able to scale globally without any borders. So really, you have virtually limitless scaling opportunities, and the international opportunity is in super early days. Ultimately, when you look at it, and given internet proliferation in some secondary and tertiary international markets. So I think it might be a little myopic for investors to look at where are things now, what are the cash flow characteristics now of the international, because we do think it can replicate what the domestic looks like, perhaps on a slightly kind of lower revenue per user.
James, thanks for your perspective. Good to see you. James Cakmak is Clockwise Capital Partner.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.